It was a Tuesday afternoon. The transaction beeped, not with a failure signal, but with an impossible silence. The digital register simply showed 3 dashes. No error code, no insufficient funds, just a frozen void where the number $47.12 should have been confirmed. Sarah tried her second card, then her third. All high limits, all unused capacity. The machine accepted the plastic, processed the magnetic strip, and then denied the finality of the exchange. The attendant looked at her, tired, already knowing. She wasn't the first that hour. That moment, standing under the buzzing fluorescence of a roadside convenience store, felt small, isolated, a minor technical glitch in a massive, sprawling financial network. But looking back now, it was the first tremor. We were trained to believe in the inviolable nature of numbers, that a dollar was a dollar, a confirmed transfer was proof of value.
But the failure wasn't in the wires or the servers or the bank accounts. It was in the fundamental agreement that the symbols we traded held any meaningful weight at all. We watched the systems seize up, one by one, believing we were witnessing a software breakdown. We were wrong. What broke was trust. For decades, the entire edifice of modern life was built on an astonishing, unspoken agreement, the effortless velocity of money. We stopped counting physical notes. We stopped demanding gold. Value became instantaneous light on a screen. The system worked because it was invisible, predictable, and utterly convenient. This was the era of the seamless morning commute. Think of a payroll deposit at midnight, arriving precisely when expected, converting immediately into mortgage payments, utility bills, and subscriptions without a single human intervention. This reliability wasn't just a convenience, it was the psychological bedrock of productivity.
You worked 5 days, confident that the invisible mechanism would flawlessly transfer your effort into spending power. That confidence allowed us to plan, to invest, to defer gratification. Money was simply a language we all agreed to speak fluently, universally. It was fast, it was fungible, and most critically, it was always there, backed by the sovereign promise of the state and the perceived stability of the entire global apparatus. The total volume of human activity, from the massive shipping of containers across oceans to the smallest coffee purchase, depended entirely on the instantaneous acceptance of a digitized promise. We never questioned the utility of the number itself. We only questioned if we had enough of it. The critical flaw wasn't in the complexity of the equations, but in the simplicity of the assumption. Every frictionless transaction, every instant transfer, every loan that moved at the speed of light required a central arbiter. The banks, the central clearinghouses, the regulatory bodies, they all functioned as the ultimate priests of value. Our trust was efficient because it was centralized. We surrendered the need for physical proof in exchange for guaranteed speed and the breathtaking complexity of global commerce. This centralization, while convenient, created a single monolithic point of failure. The inherent risk was never internal fraud or minor defaults, risks the system was designed to absorb and compartmentalize. The risk was a complete structural loss of faith in the integrity of the arbiter itself. Why did this happen? Because the incentive structure became fundamentally misaligned. The central arbiters were incentivized to expand the total volume of money and credit, ensuring liquidity and continuous reported growth, often at the direct expense of maintaining the ironclad, demonstrable backing that historically made the currency intrinsically trustworthy. The goal shifted from preserving inherent value to maximizing transactional velocity. They printed, they leveraged, and they guaranteed far beyond any reasonable measure of underlying assets. And because every major sovereign entity was compelled by the very nature of the interconnected global system to maintain velocity, a collective point of no return was silently crossed. The promises underpinning the system became too large, the backing too thin, and the reliance on continuous, high-speed issuance made the entire structure brittle. We had traded intrinsic, tangible value for an implied, digital convenience. This reliance would become the very mechanism of its collapse. But the real question isn't why the system broke, But what specific actions turned the implicit agreement of value into an explicit, public betrayal? The initial failures weren't widely publicized. They occurred in the specialized language of high finance and logistics.
For 3 weeks leading up to that Tuesday afternoon, there were quiet, creeping delays in the global settlement network. These were not the typical 3-day holds. These were inexplicable, escalating pauses in the final recognition of value between sovereign banks and their institutional clients. Imagine two massive commercial operations interacting. One delivers a critical commodity, the other pays. The commodity is delivered, the digital payment is initiated, and then nothing. No confirmation, no rejection, just suspension. This immediate non-recognition caused localized gridlock, creating economic shadows where liquidity was expected to flow freely. The first industry to feel the pressures of this financial sclerosis was long-haul logistics. A truck driver needs fuel now, paid for via a corporate flute card that draws instantly on a large, high-frequency line of credit.
But if the fuel station's bank cannot instantly confirm through the central clearing mechanism that the digital promise of the trucking company's bank will settle unequivocally the next morning, the physical transaction stops. The risk tolerance drops to zero. It wasn't a shortage of goods, it was a refusal of the mechanism of exchange. Suddenly, convenience stores weren't just running out of confirmation slips, they were running out of core inventory, because the payment for the refrigerated diesel to bring the milk in was stuck in an algorithmic purgatory. This was the first undeniable breach of the speed premise. Velocity was slowing down. The financial authorities in the early days seemed utterly blind to the cognitive failure occurring on the ground. They reacted precisely as they were trained to react during a classic liquidity crunch. They injected vast, unprecedented amounts of reserve capital. They assumed the settlement freeze was due to a momentary shortage of available reserves held by key players. They poured trillions of dollars, euros, and yen into the system, trying desperately to grease the gears that had seized up. But the problem was not a lack of money. The problem was a systemic, rapidly spreading lack of belief in the money already issued. Injecting more currency into a system where confidence was collapsing was like trying to put out a fire with gasoline. It accelerated the panic among the few sophisticated actors who understood the distinction between temporary illiquidity and structural insolvency of faith. When the central banks kept injecting and the settlement times kept expanding, the large institutional players recognized the terrifying truth. The guarantees that underpinned their stored value were now being tested in real time, and the arbiters were admitting, through their excessive reaction, that they did not control the narrative anymore. This fear of delayed settlement cascaded rapidly from the secure digital realm to the volatile physical market, making simple short-term debt contracts, the foundation of all commerce, toxic almost overnight. Why lend money for 30 days or even 3 days if you cannot guarantee the currency you receive back will be accepted by your suppliers when it arrives? The confidence interval shrunk from years to hours and then inevitably to zero. This was the unseen tipping point, not a spectacular crash, but a slow, agonizing halt, caused by the collective realization that the numbers on the screen were just that, numbers, waiting for a trust that was no longer forthcoming. This quiet failure of recognition was about to transform the world in ways no one had modeled, creating a domino chain far beyond the reach of any fiscal authority. What unfolded next was the inevitable yet universally denied consequence of that structural complacency. The central error, the point where the system ceased to be merely fragile and became terminal, was not the liquidity crisis itself, but the collective, instantaneous realization that the solution deployed to fix it was entirely immaterial. For decades, the standard operating procedure for any significant market threat was the same. The guarantor of last resort, the central authority, would flood the system with the required medium of exchange. This was the fundamental promise underpinning the entire post-Bretton Woods architecture. Fear could be controlled by supply. But on day one, when the initial freezing of credit lines morphed into a true systemic shutdown, this historical fix became the ultimate accelerant. The initial wave of quantitative easing and emergency funding injections were performed with mechanical precision. Trillions were mobilized overnight, ready to be channeled into banks, clearinghouses, and money markets. Yet the required effect, the restoration of faith, never materialized.
It was a purely psychological barrier that the electronic influx could not penetrate. Imagine pouring water into a glass that everyone suddenly decides is full of poison. The quantity of water is irrelevant. The perception of its utility has been fundamentally altered. The true climax occurred not in the trading pits, but in the quiet, highly specialized world of collateral management. When banks lend to each other, especially in large volumes, they must post collateral, usually highly liquid, supposedly risk-free assets like government bonds. As the perceived risk of default escalated, the quality of required collateral dramatically increased. First, they demanded more collateral for the same loan. Then they demanded different collateral. This escalated quickly from a demand for high-quality private assets to an insistence on only the purest sovereign debt.
But then came the crucial shift, the definitive break. The largest clearing institutions, the hubs that manage the risk for everyone, began to reject the sovereign debt itself as being insufficiently reliable. They were, in effect, rejecting the very promises of the state that issued the currency they were using. This was the structural collapse. When the mechanism for settling obligations, the most basic function of modern finance, began to reject the highest form of fiat collateral, it signaled that trust had not just been damaged, it had been eradicated. It meant that a government promise, even the promise to pay back in the very same currency, was no longer considered a safe harbor. The immediate feedback loop was devastating. If government bonds, which act as the global reserve asset and the foundation for countless financial calculations, suddenly carried counterparty risk, then every single transaction built upon that foundation became instantly suspect.
The central bank, having committed to providing unlimited liquidity, was now effectively injecting a medium that the market deemed toxic. Every new dollar created to stabilize the situation only served to further devalue the trillions already in circulation, eroding the scarcity and predictability that defined its utility. The market had discovered the hidden cost of the unlimited guarantee. If the supply is infinite, the demand is zero. The final hour of day one saw the end of fungibility. The money still existed in bank accounts, numbers on screens, but its power to transact was localized and tribal. A dollar held by Bank A was no longer necessarily equal to a dollar held by Bank B, because the ability to reliably clear those dollars against a universal collateral standard had vanished. The effect was hyperlocalization. Businesses required immediate physical verification of assets.
The digital promises that fueled global supply chains, letters of credit, forward contracts, immediate wire transfers, all stalled because the risk of holding that medium for even 24 hours became intolerable. Why accept a payment in a currency you suspect will be debased further tomorrow, or one that may not be recognized by your primary counterparty? This is the ultimate undeniable truth of the system. Money is first and foremost a technology of prediction. It allows us to predict with near-perfect certainty that the unit of value accepted today will be accepted tomorrow, everywhere, for anything. When that prediction fails, when the predictability of the medium collapses, society instantly loses its ability to coordinate effort across vast distances and long time horizons.
The specialization that defines the modern world, the doctor who focuses on medicine, the engineer who focuses on bridges, requires absolute faith that the abstract value they receive in exchange for their singular effort will allow them to acquire the goods produced by everyone else. Without that universal acceptance, they are forced to stop specializing and start hoarding the necessities: food, fuel, physical protection. The complex, interwoven economy fragments back into localized barter, immediately reducing the aggregate efficiency of humanity by orders of magnitude. What truly broke was not the bond market, the stock market, or even the banks. What broke was the foundational mechanism of social cooperation. The technical failure in the collateral markets was merely the physical symptom of a philosophical realization. The invisible contract of trust, which guarantees that others will honor the abstract symbol we call money, had been unilaterally revoked by the system itself.
The paradox is cruel. The system designed to prevent the catastrophic loss of value through unlimited intervention was the very thing that ensured the loss of faith in its own instrument. The money did not disappear, it merely became useless.
stripped of its function as a reliable bridge between labor and reward, between today and tomorrow. Day one was not marked by a loud crash, but by an unsettling silence, the cessation of countless transactions that once happened automatically, efficiently, and with unquestioning faith. The subsequent days and weeks would be characterized by the arduous, painful process of rediscovering what value means when the universal language used to define it has been corrupted beyond repair. The lesson, cold and immutable, is that complexity and scale rest entirely upon the simplicity of the underlying mechanism of exchange. We spend decades constructing magnificent edifices of finance, trade, and global connectivity, built on the assumption that the bedrock, the trust in the dollar, the euro, the yen, is immovable. But when that trust erodes, the collapse is total, disproportionate, and terrifyingly fast. The vast global machine stops, not because it ran out of parts, but because the lubricant, the fluid belief in shared value, ran dry. Understanding these dynamics, how incentives created fragility, how liquidity became toxicity, and how trust is ultimately the most valuable asset, is crucial. We must look closely at what sustains the systems we rely upon and identify the true points of vulnerability, not just the visible surface stresses. If this investigation into the mechanisms of structural trust failure is compelling, consider exploring our deeper analysis into historical parallels, how the collapse of ancient monetary systems mirrored these modern failures, and what patterns emerge when centralized promises fail on a grand scale. That discussion is available now.